Hi, and welcome to the Stockscores Market Minutes for June 8th, 2015. This week I want to talk about the three-step correction signal. Stock market corrections are feared by most investors. I constantly receive email from people saying, is this the start of a correction? How should I deal with the stocks that I own if the market is correcting? The thing is, stock market corrections don't happen overnight. They can be anticipated. They tend to happen or play out in three steps. Step number one is a break of the upward trend. Step two is the formation of a falling top. And step three is a breakdown from a falling top. Essentially, if you can draw lines on a chart with a ruler, you can anticipate corrections using these three steps. Now remember that corrections ultimately create great opportunities. So they shouldn't be feared. They should just be watched for. Now here's a chart of the S&P 500 for this week. This is the intraday chart, 60-minute chart going back 30 days. If I was to have drawn a line across these bottoms right here, you would see that that line was broken. So in a very short-term sense, we had a break of the upward trend line on, what was that, May 26th. And then more recently, I've drawn a line across these bottoms, and that line was broken on Thursday of last week. Well, notice that we had a break of the trend, we had a rally which failed to make a new high, and then we had a subsequent breakdown from a falling top. This top is lower than this one. So in a very short-term time frame, this only being a 30-day, 60-minute chart, we have seen a breakdown that implies that further weakness is coming. Now, when we look at the longer term chart, we don't see that yet. That green line that I've drawn, which is the long-term upward trend line, has not yet been broken. So in our correction, in terms of anticipating a correction, we're only seeing a very short-term signal. And that could turn into something bigger, but at this point, it's not yet anything to worry about. Now, if, however, that green line is broken, and then we watch for a break of the from a falling top. So if the market fails to make a new high, makes a falling top, and then breaks down, then we have something to worry about. Now, one thing I do want to point out in this chart is notice the red line that I've drawn across the tops is not at the same slope as the green line that I've drawn across the bottoms. That's something called a rising wedge pattern. That means that the buyers are losing power over time. Every time they can push the stock to a new high, it's just not that much of a bigger new high than it was before. And so that implies that the buyers are losing their enthusiasm over time and the sellers are gaining enthusiasm. So I do think we need to be cautious about the market. There's not yet a strong signal that a correction is coming, and I'll watch for that each week with the Market Minutes video. But at this point, I think you just want to be cautious. Now here's something interesting. This is a daily chart of the Russell 2000. And you can see here that the chart isn't showing that kind of breakdown that we saw on the S&P 500. And I think what's happening here is the market is anticipating a raise in interest rates. Since 2009, we've had even 2008, we've had a very accommodative U.S. Federal Reserve. They've been printing money, they've kept interest rates very low, and that has motivated people to buy large cap U.S. stocks in search of yield. Well, if that era of low interest rates, of accommodative monetary policy is ending, then it implies that the trade that people had for the last 6 years is no longer the good trade, and that mainly has been buying large cap US stocks. Now before 2009, the places to make money were the smaller cap stocks. There was volatility, there was action in them. That's where we traded. We only started trading boring large cap stocks because that was the hot game, and it's been the hot game for 6 years. So what this is telling me is that the market is expecting interest rates to start to go up. People have less desire to own these large cap stocks, and then we may go back to the way the stock market was pre-2008 when people bought stocks on speculation, that they actually thought about the companies that they were buying instead of buying an ETF that was a basket of companies or buying a stock just because it had a yield. Now, I'm not sure that that's going to happen yet, but we're seeing early signs that that is underway, and we'll want to watch for that. Here's a chart of the Tsx 60 ETF, 60-minute chart going back 30 days, and you can see that there are falling tops on this chart. That means that in the short term, there's pessimism building. Now, the support line, which I've drawn here in green, which has been bounced off of a few times, has not been broken yet, But this is some short-term pessimism building, and if we see a breakdown through that green line, that would imply further weaknesses ahead. Looking at the longer-term chart, this is now a weekly chart, you can see that that green line that I drew, which kind of best approximated the rising bottoms over time, that line has been broken in the last few weeks. Now, we have not broken through the last rising bottom, so still not a real big worry, but again, the sellers are starting to show some motivation. We need to be cautious about that. The Tsx Venture Market kind of suffered over the last week or two. It's still in an optimism building pattern. You can see that I've highlighted the rising bottoms in red and the resistance in green. I really should have those colors flipped around. But we're really seeing no action here, no life, but at the same time there's stability, and that could turn into something if again we see money starting to look for some action instead of playing yield paying stocks. Now here's another example of a trend reversal pattern. This is a chart of the US 20-year Treasury bond ETF. This basically approximates US Treasury bonds. And you can see that this went very steep, went parabolic, hit a new high. It broke that upward trend line right there at the start of February. And then it fell down for a while. It tried to rally back and it failed to make a new high. So it made a falling top there. And now we have broken that long-term upward trend line from a falling top. That happened a few weeks ago. And we're starting to get more follow through in that move. This week we had a pretty sharp downward move in US bonds. And again, the market is pricing in higher interest rates. When this goes down, that means that interest rates are going up. And I think that's contributing to this desire for people to move out of large cap stocks, which is why something like the S&P 500 looks worse than the Russell 2000. The Russell 2000, of course, approximates small cap stocks. So some more evidence that that is underway. I think it'll play out over a few months, but certainly the market is starting to anticipate that. We had a little bit of a rally in the US dollar on Friday, and this from a rising bottom. I've drawn that in green. So if the US dollar breaks this downward trend line right here, we could see a resumption of the long-term upward trend in the US dollar after a 2 to 3 month pause. So I want you to watch that chart closely because again, if you get that break up and out of that pattern, that could imply higher prices for the US dollar, which will be harmful for things like gold. And here you can see gold had a down week this week. It's generally a bearish pattern. We've talked about that week after week after week for the last few years. But it looks like it could get weaker here. Until that green line is broken, I'm not ready to say it's going to make the next leg down for gold, but something you want to watch for because the pessimism is building there. Here's a chart of oil in a little flag pattern. Long-term trend is down. It's trying to stabilize, but it needs to break up through that red line. That would be bullish. If it breaks down through the green line, that would be bearish. That's the thing you want to watch for. And finally, the fear index. We had a little blip higher in the VIX in the last little while because of some selling pressure in the market, but it's still something that's in a long-term downward trend. So I don't think fear is yet a factor in the market. I think what we're really seeing is just that rotation. People saying, I don't want to own these large cap stocks. They're getting a little overvalued. Let me go look for some value in some of the smaller cap stocks. So long-term, bullish on US. Short-term, neutral on US stocks. Canadian, neutral on both time frames, but a little more caution in the short term. Gold, bearish on both time frames. Oil, bearish long term, neutral short term. Watch for those breaks out of that little flag pattern that I just spoke about. The long-term upward trend is still in place, but the sellers are starting to show some motivation, and this could be the start of a rotation out of large cap and into small cap in an environment of greater price volatility. As a trader, to be honest, that's what I'm hoping for. That would make the trading environment a lot easier, but I think it's still got some work to do. The US dollar may resume its upward trend, and if that happens, that could really hinder the recovery in oil and the attempts and recoveries in the other commodities. Well, that has been the Stockscores Market Minutes for June 8th, 2015. Have a great week in the market and trade well.